Hello and good morning, everyone. I'm Nancy McClernand, President and CEO of the Global Business Alliance, and welcome to the Q2 Economic Advisory Council, which is presented by the Global Business Alliance and the Institute of International Bankers. Today, we are pleased to host UBS, one of the world's leading international banks that is making substantial investments in the United States. For those of you who are joining us for the first time, a little bit about the Global Business Alliance. We are a trade association with approximately 200 international companies doing business in the United States across a very wide variety of industries, including manufacturing, retail, hospitality, and the financial sector. Companies like Nestle, Toyota, Samsung, and UBS. GBA advocates for policies that ensure that the United States remains the most competitive location around the world for foreign direct investment, which in turn increases American employment and U.S. economic growth. We believe an essential element of achieving that objective is to continue to strengthen our global connections with our friends and allies around the world. Today, international companies employ nearly 8 million Americans directly. And there's a fun fact, 69% of all new manufacturing jobs created over the last 5 years were created by international companies in the United States. These quote unquote foreign firms really are embodying made in America. In each and every zip code, there are American companies that were founded abroad and now have major operations and employment in the United States. So I'm really pleased to partner with the Institute of International Bankers on the Quarterly Economic Advisory Council. Given the extraordinary shifts in the US and global economies in the past few years, providing policymakers and those in the DC community expert information and unfiltered practical analysis is critical to finding the best policy outcomes. So now I'd like to turn it over to my colleague and friend, Bridget Polachine from IIB. Bridget?
Good morning. Thank you, Nancy, and many thanks to your GBA colleagues who have been such valuable partners with the IIB in this Economic Advisory Council. I'm Bridget Polachine, CEO of the IIB. The IIB represents internationally headquartered banks who operate in the US, where we advocate for national treatment, a level playing field, if you will, so that foreign banks can continue to significantly contribute to the growth of the US economy. This is the fourth in our series of Economic Advisory Council sessions where we present experts from our joint bank members to share their insights on various pressing economic developments. Insights that are especially valuable because they reflect a global perspective. It is my honor to introduce today's expert speaker, Pablo Villanueva, Senior U.S. Economist at UBS. Pablo's career has been at the intersection of macroeconomics and financial markets. Before joining UBS, he spent nearly 5 years as a senior U.S. economist at the British macro hedge fund Rocos Capital Management. Previously, he was a macro strategist at TPG Capital and at the Bank of America Merrill Lynch. He holds a PhD in economics from Stanford University, where his academic research focused on finance and macroeconomics. Pablo is going to give us a few minutes of remarks and review some slides before we turn it over to questions from the audience. Please submit your questions via the comments icon. We really want you to take advantage of having Pablo available to you today. Pablo, thank you so much for joining us. I'm sure you're a very, very busy man these days. I know I'm not alone in looking forward to hearing your thoughts on the economic outlook, inflation, rate hikes, supply chain disruptions, yield curve. I think we might need more than 1 hour, but let's get started.
No, thank you very much, Bridget, and thanks everybody for being here. Yeah, it's been very interesting to be an economist over the last year or so because I think there's no social event I go to in which there are no questions on either inflation, the possibility of a recession. Seems that right now the state of the economy is really on everybody's minds, not only highly skilled professionals like everybody in this room, but overall across several sectors of the of the population. I'd like to start the presentation now. If you could bring up the slides, please. Thank you very much. The main question, the main questions we're getting over right now at UBS are two: is inflation going to come down? Number one, and second, is there going to be a recession? And here I'd like to start with three slides that are going to be a bit of a summary of how we're thinking about this. One of the reasons we have seen very high inflation over the last 18 months or so is not only because demand was very strong and following during the pandemic, but especially because supply has been very constrained. I mean, there have been lockdowns, lockdowns in different countries over the last 2 years. Even right now, there are still lockdowns in one of the largest economies in the world, in China, and that's having some constraints on the economy. But another reason that has happened is because, I mean, early in the pandemic, the level of investment in the U.S. domestic investment really was quite low. In this chart, we show two lines. The blue line is a summary. We call it a principal components, which is a summary of investment intentions. So different surveys across different regions, the firms are asked, are you going to make investments over the next 6 months? And as you can see, this blue line during the pandemic, it was like 3 or 4 quarters very, very low with very little capex intentions. And that was reflected in the actual data, the black line, which shows the investment in equipment, for instance. So capex intentions are a good predictor of where we're going to see actual investment happening 6 or 9 months later. So when we started the year in 2022, these capex intentions were at historically high levels. So we were actually quite optimistic that this very strong investment was going to increase supply and put downward pressure on inflation. And it is still at somewhat high levels, but something has happened over the last couple of months. This last data point, which corresponds to essentially April and May, and we're already starting to get some data from June, shows that these capex intentions are really collapsing or coming down somewhat fast. And this would be very concerning because in order for inflation to come down and for a recession to be avoided, investment is an important sector that has to be there. And to the extent that companies are losing the confidence that they should be making investments, makes us more worried about two things: about inflation, and about the outlook for the economy. There has been also over the last 2 years, especially early 21, there were supply constraints on the labor side. So there wasn't access to childcare in many situations. So a lot of people had to stay at home, even if they wanted to go out and work, because they didn't have where to keep their kids. There were also some concerns still about the virus. People were very hesitant about going out to face and working in face-to-face industries. But here the blue line shows us what's the labor force participation rate, which is the percentage of the population, of the adult population, that it's engaged in the labor market, either actively working or looking for a job. So when the pandemic hit, this collapsed. And during 21, it remained really, really low. As I said, a lot of concerns about the virus, about childcare, etc. But starting in late 21, there has been a consistent increase in labor force participation, in labor supply. And we think that that's going to continue, and that's going to provide some relief to some of this very tight labor market that we're seeing, simply because people are having now more confidence to go back to work. And not only because the virus seems to be mostly behind us, but also because people are feeling in their pockets the very high inflation. Incomes, even though wage growth has been strong from a nominal perspective, real wage growth, it's somewhat constrained, and people are receiving a personal negative income shock. That being said, the black line shows us what's the level of participation adjusting by demographics that would put us back to the 2019 levels. And 2019 and early 2020 was a period with very high labor force participation. And here what we see is that this black line is downward sloping. And why is this? Because of demographics, a lot of people are now retiring, getting to the age in which they 65 years and older and leaving the workforce. So demographics are putting a very important downward pressure on labor force participation. So as bullish and optimistic as we are on the potential of labor supply to come and give some relief to tight labor markets, we're going to soon be hitting a wall in which there's simply going to be even more difficult to find more people, simply because the current population composition skews towards older people that tend to be out of the labor market. And so first, we're somewhat optimistic on supply, both on the business investment and on labor force participation, but there are some important headwinds. One, companies are having less confidence they could make investments. And two, we're going to start facing a demographic constraint on the labor side. So despite this, we are somewhat quite optimistic on the outlook of inflation. We think that inflation in Q1, this is core PCE inflation, which is the measure that the Fed targets. Well, the Fed targets PCE, headline PCE, but core PCE removes energy and food from the calculation. And the reason we do this is because core PCE is a more useful forecaster of future inflation than headline PCE. So core PCE peaked in Q1 at around 5.3%. We think it peaked. The print in April showed a decline also in March. And we think that that's going to continue. And we think that the decline could actually be pretty fast. And I'm going to spend a few slides on why I think inflation decline could be very fast. But the yellow diamonds are forecasts that are made by the Fed and they were released last week. So we have a more optimistic view on how fast inflation come down than what the Fed does. And it's one of the reasons that even though we're starting to see some important pockets of weakness in the economy, the fast decline in inflation that we expect is one of the reasons we expect that, one, the Fed won't be able to be as aggressive towards the end of the year in terms of monetary policy tightening. And two, that's going to provide some relief to the economy and it's going to provide a path in which a recession is avoided. Now, I'd like to go into the details of the inflation forecast. One of the most important reasons we expect inflation to be down fast over the coming quarters is this chart. In this chart, we show all the different items that make up the consumption basket. On the x-axis, on the horizontal axis, we show what's the persistence of inflation of these items. So, for example, here we have tuition, school fees, and childcare. Very high persistence. It means that inflation of tuition today has a lot of information about what future inflation of this item is going to look like. On the flip side, we have airfares, which have low persistence. So even if we're seeing very strong inflation, that doesn't tell us much about where future inflation of this item is going to be. And the interesting thing about this chart is that it shows, and in the vertical axis, we're plotting the actual inflation that we have seen for these different items. So it shows that the items that have had very high inflation, like airfares, like natural gas, like gasoline, like cars, these are items that have very little persistence. Whereas the items that are seeing lowish inflation, like tuition, like medical care services, like restaurants, these are items that we think are that tend to have a lot of forecasting power and they're not showing super strong inflation. So that tells us that the nature of the shock is going to lead to an inflation path that's probably not very persistent. So this is a very important reason why we expect low inflation. The second important reason is because we're seeing the supply constraints ease. Cars are some items that have seen very, very strong inflation over the last 18 months. And the production schedules of cars during 21 and early 22 were still, production was very constrained, well below pre-pandemic levels, and even below the second half of 2020 levels. What we're seeing now is that the production of cars it's finally moving up. So it seems that supply constraints are being eased, and that's gonna should put some downward pressure on inflation of cars. On the demand side, we're also seeing that the consumer is starting to be more aware and more responsive to this very high inflation. In this chart, we show 3 lines. The red line is the consumer sentiment, which is at historically low levels. So the consumer is still starting to be very concerned about the outlook. And the black line shows what are the buying conditions for cars, according to the consumer. And the red line is the buying conditions for homes. So all these lines are coming down, which is telling us that the consumer is now very concerned. It's assessing that the conditions to buy houses and to buy cars are pretty bad, historically bad, and we think that's gonna it's gonna constrain the consumer as it decides how to spend its money and how much to consume. And the final reason we're fairly optimistic on inflation is this chart. On this chart, on this slide, we show 3 charts. The first one shows us aggregate demand, the consumption of households. And we see that the real consumption of households is pretty much in line with the trend pre-pandemic. It was very weak for a few months during the second half of 2020, but it's now at the aggregate demand is back to the pre-pandemic trend. But the composition of demand is very different and has been very different for the last couple of years. On this chart on the middle, we show the consumption of goods. So physical stuff, furniture, cars, toys, recreation, video games, TVs, physical stuff. And we see that over the last 2 years, the consumption of goods has been through the roof. I mean, and part of the reason is because people were, for the most part, they didn't have confidence to go out and spend money in baseball stadiums, in restaurants. There were some lockdowns, and we're seeing that even up until late last year, the consumption was incredibly high of goods, because essentially people, especially with the Omicron variant at the end of last year, people were spending more time at home than what they were pre-pandemic. On the flip side, the services consumption, restaurants, travel, etc., was very constrained. This matters because what has been driving inflation over the last 2 years, and it's cars, the blue columns here, and other goods, the red columns, and services have actually been somewhat well behaved. So to the extent that the consumption of goods normalizes and people stop spending money on durable goods, on furniture, TVs, etc., that's gonna bring some relief to the supply chain issues, and it's going to bring down inflation relatively fast. And even anecdotally, we're already starting to see, say, the earnings call of some of the businesses, Target, Walmart. They're already flagging their CEOs that the type of consumption that the consumer is looking for over the last couple of months is very different than what we were seeing, say, even 6 months ago. So it seems that the consumer is moving away from this consumption of goods, and these companies are saying we maybe have too much inventory now of these goods, physical goods, so we might have to start giving some discounts to get rid of this inventory. Let's see if that happens. But if it did, it would be a major downward pressure on inflation pretty soon. And finally, this line shows us the level of supply chain disruption. It's this is collected by the survey by ISM Manufacturing, and they ask firms how long is it taking you to deliver your products. So last year it was taking very long time to deliver products. I mean, if you had any experience buying furniture or other durables last year, it was taking a lot of time. Those times have really come down recently. They're now back to levels last seen in 2018 when the economy was very strong, but when there wasn't all this concern about supply chain disruptions. And something that's very important is that these last few data points are low, even though China lockdowns are still there. So even though the global economy is still not functioning very smoothly, China is still seeing some major mobility restrictions. This it seems that the supply, the time it takes to deliver products is really come down. This is another a composite of supply chain stress that we publish, and this is more global, not only focused on the U.S. And it's telling a similar story that the supply chain issues are diminishing. Finally, for the last 10 minutes or so of these initial remarks, I'd like to make a comment about the supply constraints on the labor market. The labor market has recovered very strongly. Despite that, the level of employment is not back at the pre-pandemic level. We're still about 1 million jobs, slightly less than the level seen in February 2020. We're also starting to see one of the features of the last 12 months was that the job openings were very, very strong, very, very high, so that the number of job openings per unemployed worker was very high. And that was giving a lot of power to the worker, and it was to some extent constraining the supply side as well, simply because it was difficult to find workers. But we're already starting to see that the demand for workers is coming down. And this blue line is it's not the official job openings data, but we have our own UBS Evidence Lab data, which we collect different job openings. It's using a big data approach. And we're already seeing that in June, and already even starting in May, the number of job openings was starting to decline. Also, on the supply side of the labor market, a very big story has lately been not only that there's less people because the population is older than 2 years ago, but even within groups, there has been a bit of excess retirement. And I think the poster child of that, the story is the group that it's 65 years and older. This is a group that, in this chart, we show the percentage of 65-year-olds who are out of the labor force due to retirement. So in 2008, around 75% of the population who was in this group was not working, that was already retired. That number actually came down quite a lot, and pre-pandemic it was around 73%. And lately there has been, and during the pandemic, there was a very important increase in the number of retired workers within this group. We think that this group is going to be difficult to get a lot of labor force from them. I mean, it seems that the retirement decisions of this group could be quite persistent. But in younger groups, where we also saw an increase in retirement rates, for example, this is the group 65 to 64-year-olds. During the pandemic, we saw an increase between 2020 and early 22 in the retirement rates of this group. But lately, that retirement rate has been coming down. So it seems that they're going to be able to provide some more labor supply. And when we also, in this chart, we show what's the percentage of people that are not in the labor force, but who want a job. The red line is the data for 2022. And it gives us a sense of how engaged people are with the labor market, even though they're out of the labor market. And what we're seeing is that the level of engagement with the labor market is higher than in 2019. And 2019 was a year in which labor supply was increasing quite strongly. So this also gives us some optimism that some of the supply constraints on the labor side that we have seen are going to be eased somewhat, and that's going to help with putting downward pressure to inflation. The same is what we're seeing with the percentage of people who are out of the labor force who intend to look for a job in the next 12 months. So the level is, we're still seeing a level of engagement with the labor market similar to what we're seeing in 2019, and this gives us optimism that labor supply is going to come back. Also on the labor supply side, one of the main characteristics of this of the pandemic is that we have learned how to work more efficiently in a more flexible slash hybrid slash remote world. And I think even this conference is a testament of that, in which we have people from all over the world that maybe 5 years ago would have had to spend a lot of money and a lot of resources and time to attend a conference in Washington, D.C. And now this can be done in a more efficient way remotely. Why does this matter? Because one of the groups that we think could provide a lot of labor supply relief is prime age women. So the prime age women is people between 25 and 54-year-olds. This is a group that in the past has been very sensitive in its labor market decisions to the state of the economy. So it's what economists called, it's a group that has a fairly elastic labor supply. So to the extent that we are now in a world that it's more flexible and we think that this group could respond quite strongly, providing labor supply. And it will be quite a change, because this group between 1950s and the early 1990s showed a very, very strong increase in labor supply. But over the last 35 years, that progress of the previous decades hasn't really continued. And the changes that we're seeing in the labor market, we think could be a before and after in terms of labor supply of this group, and it could provides also some relief to the labor supply constraints that we're seeing. And an important thing to say here is that, not surprisingly, this is the group that has been driving the rise in labor supply lately, and we think that that's going to continue. On the negative side, on the labor supply, demographics are not helping. COVID intensified these demographic issues with a lot of deaths, sadly, and a decline in births. And very importantly, it intensified the decline in immigration. This is the net international immigration by year. It peaked in the mid part of last decade, and it really intensified during 2021, probably driven by the pandemic. So the lack of immigration is an issue that could lead to these labor supply constraints lingering, and for the economy to remain with very high inflation. I'm going to leave it at that. I think we're going to have time for Q&A to discuss other aspects of the economy. But in general, the main thesis we have is that these supply constraints are easing relatively fast, and that's going to provide some relief to inflation. Second, also on the demand side, the composition of demand we think is going to change in a way that's going to be very favorable to lower inflation. These are some of the reasons why we're expecting a fast decline in inflation. And if that happens, we think that the tightening of financial conditions that the monetary policy authorities, not only in the US but in the world, are going to have to do are going to be a bit less aggressive, and that's going to provide a path for the economy to come out of this inflationary shock with still a somewhat okay, I don't want to say extraordinary, but okay economic growth, and avoiding a recession. And so those are my prepared remarks. Thank you very much.
Thank you, Pablo. Very interesting. We have some questions that have come in, and I want to encourage people to submit questions through the comments function. First is, no surprise, lots of questions about recession and rate hikes.
Yeah.
So the first one is, a recent survey of CEOs reveals that they are not optimistic about avoiding recession. What piece of the economy would you point to as the most hopeful reason as to why we might be better off avoiding a recession than some have
Yeah.
predicted?
Yeah, that's a great question. And I think this lack of optimism of CEOs, we're seeing it in the data. Like the first chart I showed, that they're reducing their capex plans. I think the most optimistic part is that the consumer is in a very good shape. The consumer is 2/3 of the economy, and contrary to where we were in 2007, the balance sheet of households are very, very strong. Even though interest rates have increased, the interest rate burden is still very low relative to income, especially compared to where we were 15 years ago. And also the consumer saved a lot of money during the pandemic. I mean, we have all these excess savings, north of $2 trillion, that the consumer can use and actually has been using. I mean, there has been a very important decline in the savings rate, and it's one of the mechanisms through which a consumer is deciding to face this inflationary shock is by reducing its savings, and it has accumulated a lot of savings. So we think that could continue for a couple of more quarters, and that could provide some relief. So the consumer is definitely the ability of the consumer to face this economic outlook is quite strong. On the negative side, the willingness of the consumer to might be different, right? I mean, here there are two components: the ability and the willingness. And the willingness is, we're seeing in this survey that the consumer is losing confidence on the economy, and it's going to have to make a decision soon, now, whether it's willing to continue consuming and using its savings, or simply cut back consumption and tip the economy into a recession.
If there is a recession, what will it look like? Deep, shallow, which sectors might be most affected? What would you predict?
I think the question of which sectors is probably easier to answer. The sector that was very, very strong over the last 2 years was manufacturing, and the reason was because we were stuck at home consuming goods and spending money on Amazon and Walmart and Target and getting everything delivered online. But it seems that the consumer, I mean, has already bought all the furniture and toys, recreation. I mean, the problem with durable goods is that they're durable. So you don't have to be buying one sofa every year, or one fridge every year. So I think the part of consumption that consumers are going to be probably cutting fast, even in the absence of a recession, but especially during a recession, it's goods. So the manufacturing sector is probably going to be suffering. The housing sector, this is where it gets a bit more controversial. I mean, a lot of people are saying that the lack of inventory should keep housing supported, but we're seeing in the data, and this is literally the data of the last month or two, so very, very recent. The housing sector is responding very, very fast and very, very aggressively to the very high mortgage rates.
Mm-hmm.
And this is something that it's very new. And mortgage rates were 3.5% 6 months ago. They're now 6%. I mean, this such a fast increase is probably going to impact the housing market to some extent. A question then is this going to be a repeat of 2008 or not? Hopefully not. And I think there are many reasons to be hopeful that not. As I said, the balance sheet of the households are very, very strong. That wasn't the case in 2008, and the financial sector is more resilient. But the housing sector is probably going to suffer. Which are the sectors that would probably do okay? Services. I mean, restaurants, traveling, This is a sector in which probably even a constrained consumer is dying to consume trips. And I mean, a lot of weddings that didn't take place over the last 2 years maybe are going to have to happen. So it's going to have to, or family trips, essentially. So probably the services sector. How deep? Um, that's a very difficult question to answer. I think it wouldn't be that deep simply because the manufacturing sector is less. I mean, the importance of the manufacturing sector from an employment perspective, it's low. I mean, in the end, a great advantage of the U.S. is that it's a services-oriented economy. So if the services sector is doing okay, you'd imagine that the vast majority of workers would be in an okay shape. Uh, I mean, there's a chance that, say, an unemployment rate about 5% could be avoided. And I mean, even though it's higher than the 3.6 that we have now, it's well below the upper single digits that we were seeing in the previous recession, or sorry, in the previous two recessions, the COVID and in the Great Financial Crisis. So probably the examples that are more similar to what we could see are the recession of 2001 could be like a good example of what we could be expecting.
In your remarks, you know, a lot of the focus was about how inflation is already starting to recede. The data that you particularly looked at. So, in light of that, you know, do you think that the Fed's decision last week to raise interest rates as aggressively as they did, you know, was that too aggressive? And also, you know, what do you think last week's action, coupled with the data that you're pointing to, says about future rate increases?
Yeah, I think on the first question, I mean, there's little doubt that the short-term rate, which is in the end the one that the Fed rate has more control over, is very low. If inflation is, say, core PC inflation 4.5, 4.7%, and the nominal rate is 1%, it's a very low real rate, right? And even taking into account the interest rate target, which is 2%, is still a negative real interest rate. So in that sense, going as fast as possible to the neutral rate or to a more restrictive stance makes sense. So it's difficult to say that it was too aggressive. What was maybe uncommon and somewhat risky was the way in which it was implemented, in which the Fed for the 2 weeks it was consistently saying we're going to deliver a 50 basis point hike, and in the end there's a leak to the press, and the Wall Street Journal publishes a note. I mean, it seems like the communication could have been better, and there's a risk that the Fed starts to lose credibility, because if it's promising to do something and it changes the mind in this atypical way, it could be somewhat concerning for future promises that the Fed makes. But I wouldn't say it's a major mistake. I mean, I think it's something that was uncommon. Sorry, your second question was on
what this might portend for future rate hikes.
Yeah, I think, I mean, the main message of last week is that the Fed is very willing to take rates higher, even at the expense of weaker economic growth, and that tells us that it's willing to increase significantly the probability of a recession. So it's very committed to its inflation mandate, and rightly so. Like it's a very important mandate. So we do expect that over the near term, say the next 3 months, the Fed is going to remain very, very aggressive. But there is going to be a point towards the second part of the year, probably towards Q4, in which if inflation is indeed showing the signs of weakness that we expect, the Fed has to look at itself in the mirror and say, okay, am I really willing to send the economy into a recession if I'm already seeing inflation coming down or not. And I think that's where we somewhat differ from the rest of the economies. We think that when that moment happens, if inflation is indeed coming down, the Fed is going to be quite open to giving the economy some breathing room to avoid a recession. But it heavily relies on the path on inflation, and that's why I spend most of the talk talking about inflation, because it's the easy part. If we are wrong and inflation in 6 months is still 5% core PCE, I have strong confidence that the Fed will remain strong. And I think they gave us a glimpse of that last week. Yeah.
How do you think, another question is about, this is probably more of an economist question,
Yeah.
the Fed's new framework, or I guess it's
Yeah.
not that new, but of,
Yeah.
balancing employment versus
Yeah.
sort of changing their targets. What might they be looking for on the employment side that would impact their actions around rate hikes and inflation targets?
Yeah, I mean, I think if they start to see major job losses, say between 500,000 and 1 million job losses over a period of 6 months or so, I mean, I think even if they're not seeing inflation coming down, they will have high confidence, I think, that inflation is going to be coming down. And simply because the wage pressure is not going to be there. And I think in that scenario, and we put out a note recently on this topic, once that's happening and once inflation is not that strong, I think they would react very dovishly and cutting rates very fast to prevent a major drainage of jobs.
Mm-hmm.
So a major recession. But at that point, they will essentially say, okay, we're going to have a recession. Let's have it, but let's prevent a 9% unemployment rate. And yeah.
Do you have any thoughts on some of the other measures that have been suggested to respond to inflation and what's happening in the economy, like reducing or eliminating tariffs on Chinese goods? Gas tax holiday is now a hot topic.
Yeah.
Any thoughts on the need
Yes.
or effectiveness of those proposals?
I mean, a difficulty with the tax gas holiday is that it's essentially boosting demand. And probably what the economy needs now is to cool demand a bit. So in that sense, it's unclear. It's unclear to me if it's gonna be useful, and if anything, it could be somewhat counterproductive, because I mean, gasoline consumption is very inelastic. So consumers are gonna be still consuming the same amount of gasoline than with very high prices, but also of other aspects of putting also the upward pressure on inflation of other items. So in the end, the tax holiday is a fiscal stimulus, and a fiscal stimulus is probably not the most appropriate response to decline inflation. If anything, we need a little bit of fiscal contraction that we are seeing to some extent. On the case of tariffs, that would probably help. Yes, the magnitudes are probably not huge. We're talking maybe 20 to 40 basis points on inflation, so between 0.2 and 0.4% of inflation. So it helps, but the magnitude of the shock, of the effectiveness of the response, it's very small compared to monetary policy tightening and to a normalization of consumption baskets of consumers. But it would point in the correct direction, probably. But yeah, I mean, it's interesting with economics. Sometimes the best response, it's not to do much, or not overdoing. And I think the gas tax holiday could be an example of that.
Do you have time for one more?
Totally, as many as
Great.
you want.
Okay. So, and this is the question, this is perfect timing that you were
Yeah.
talking about fiscal stimulus. So there have been, a fair number of economists that have pointed to the fiscal stimulus, the pandemic response, as contributing significantly to the inflation we're seeing now. But we've also know that many foreign countries are experiencing inflation as well, and their central banks are raising rates. So just wondered, taking a broader view, anything you want to say about this phenomenon globally?
Yeah. I think that's an absolutely great question. I love it because sometimes when people focus on the U.S., they forget that the U.S. I mean, it's a very large economy, the most important economy in the world, but the rest of the world also matters, and the U.S. economy is not alone in a planet by itself. And I think what the fact that we're seeing inflation everywhere, not only in the U.S., which had major fiscal stimulus, but in a lot of economies that didn't see this magnitude of fiscal impulse, does suggest that there's some issue, some other phenomenon driving this. And I think that really gives a lot of credence to the view that what has driven inflation, it's definitely to some extent the fiscal stimulus and the monetary policy easing, but especially the type of consumption that consumers are doing, because the change in the consumption basket away from goods and into services towards goods and away from services that we saw over the last 2 years was not exclusive of the US. It was seen all over the world because everybody was somewhat worried about having face-to-face contact. And I think as a world, we didn't have the experience or the expertise or the capacity to produce as many goods as the demand was the strong demand was suggesting. So what our view is as this consumption basket normalizes to the production of a stuff that we have the capacity to produce, not only from a U.S. perspective but from a world perspective, is going to give major relief to the inflationary pressures. The second comment on the international side, and I think, and very few people are talking about this, but I do believe that this is very, very important. We're now seeing a major coordinated monetary policy tightening. Almost every central bank in the world, I said almost because the Bank of Japan is not, and China to some extent is not as well, but major central banks in the world, the ECB, the Bank of England, Bank of Canada, everybody in the emerging markets, tightening financial conditions. And one thing we did learn in 2020 is that when the central banks did a coordinated monetary policy easing, the impact on economic activity and prices was very powerful. This monetary policy easing in such a level of coordination, we didn't see it in the previous 30 years. And we're doing exactly the opposite now, but on the other side, with tightening. Mm-hmm. And this is something that we didn't see in the 2000s. In 5 years ago, when the Fed was tightening financial conditions and hiking rates, the ECB was not hiking. The Bank of Japan were not hiking. Many EM central banks were actually easing. So I think there's a risk that since central banks are not internalizing, or when they're making decisions, they're not taking into account what other central banks are doing, that there is a risk of a bit of an overdoing it from a global perspective. And that could lead to, that's a scary thought, because it does say that maybe the impact that we're going to see on the economy, not only of the US, but globally, is going to be much stronger than we expect. And yes, inflation is going to come down, but everything's going to come down because everybody's tightening. And I think that's a very, very important risk that it's not really discussed. I think everybody's saying, yeah, there's a risk that the Fed ends up overdoing it. But I think there's a risk that everybody ends up overdoing it, and globally, and if the ECB overdoes it, it has a negative impact probably on the US as well, or if the Bank of Canada, and maybe the US economy is small enough that the Bank of Canada won't affect financial conditions in the US. But if you sum up very many small central banks, it adds up. And that's part of the discussion that's not really there in the debate. And that I think what we're going to see over the next 6 months, which is going to be the first time we see this response of the economy and inflation to this global tightening, I think it's going to be very interesting. And
yeah, that's really interesting. Sort of just as there was a multiplier effect of the easing, there could be like a multiplier effect of the tightening. And it's certainly something that, IIB and GBA members, given their international perspective, can be watching and serving as resources on the views around that. Pablo, this has been great. Really, really interesting. Really appreciate your insights. Thank you so much for your time. I believe the slides will be available to the viewers. And I recommend that people, there's just a treasure trove of information in that deck. We want to thank you again. Nancy, thanks. It's always great to partner with you. And again, Pablo, thank you. And we look forward to checking in the future and seeing if I won't call them predictions, your forecasts.
We can meet in a few months to find out about all the things that I got wrong. So
we only talk about what you got right, I promise. Thank you.
And please, just to communicate everybody, I'm very happy to answer questions offline later by email.
Great.
And please don't hesitate to reach out. Thank you.
I think your contact information is in the deck. So we appreciate that. Thank you for being generous with your time today and in the future. I hope everyone has a great week. Thank you.
Thank you. Bye.